My name's Ursula Tonkin with Whitehelm Capital, and today we're talking about the Whitehelm Capital Low Carbon Core Infrastructure Fund and the role that listed infrastructure can play in a portfolio. So just to give you some quick background on Whitehelm Capital, we've been an infrastructure investment specialist investing in the market of infrastructure for over 23 years. A medium-sized firm, we've got about 67 total staff spread across Canberra, Sydney and London, 70% employee owned, and a strong focus on sustainability across the whole firm. So just quickly on listed infrastructure as an asset class, we feel that it should be a defensive allocation in a portfolio, particularly if you're investing in listed infrastructure alongside, say, a global equity portfolio, with a strong focus on inflation protection and also a good dividend yield as well. So you want to invest in companies that provide a good yield and you want to see that yield grow over time. So it should have defensive properties, so a lower volatility than global equities and also a low beta. So you want a diversifying allocation rather than just doubling up on your existing global equity exposure. For us, we're very much focused on core infrastructure, spread that across the globe, across developed markets, and providing a nice diversified exposure to lower the risk. And also key to this as well is the sustainability side and the low carbon side, which can create a lot of risks for many of these sectors. So you want to remove the risk that the assets you're investing in will become stranded down the track. This chart just gives you a snapshot of the downside protection that listed infrastructure can provide. The yellow bars are global equities as measured by the MSCI World. This chart just shows the negative months, it doesn't show the positive months, but you can clearly see that listed infrastructure, measured by the blue, which is the FTSE Developed Core Infrastructure Index, does provide significant protection when markets turn down. And then the Whitehelm Fund is in green, and we aim to be even more protective again. So over the long run, listed infrastructure has a downside capture of about 70%, so it participate on average in 70% of the drawdown, but an upside capture higher than that of around 80 to 90%. So long as your upside capture is higher than your downside capture, you will actually outperform global equity over the long run. And that's what exactly we have seen with listed infrastructure. This chart only goes back to 2011, but you can see the red line is private market or unlisted infrastructure, and then different versions. So core infrastructure, the Whitehelm approach is the blue line, and then grey for the global equities. And the red line is really what we're trying to achieve from a risk return profile perspective. So Whitehelm invests in private infrastructure for our large institutional clients, and it's that kind of approach that we've brought towards the listed side of infrastructure again. So very much an absolute approach to risk and return, and very much focused on that downside protection that leads to outperformance in the long run. Now, key to achieving that is, we feel, only investing in the defensive end of what infrastructure is. There's no set definition of infrastructure out there in the market, so we've applied our own, which we've developed over the 23 years that we've been investing in this asset class, and it's very much focused on predictable, stable cash flows, a strong inflation linkage in the assets, which provides that protection over the long run against inflation for investors. You're looking for assets that have really high margins, so they have a buffer when the economy might turn down, and a monopoly position in their market, so they can push through any cost price inflation onto the user of the asset. So in practicality, that means that we're actually searching for the most boring companies that we can find. So things like toll roads that have very, very long-term concessions and inflation-linked revenues, things like fully regulated water utilities, electric utilities, and then some communications infrastructure as well, where we're investing in the tower assets, so not the service providers, and also airports and mass transit networks as well. In some ways, it's easier to describe the definition of core infrastructure by what we won't invest in. And if you like, this is kind of the John West strategy. It's the ones you reject that shape the outcome. So we definitely won't invest in power generation plants that are unregulated, and we have a very low exposure to any fossil fuel power generation. We don't invest in emerging markets for this strategy, which tend to be higher risk. You can still earn a good return from emerging markets, but it's a very different risk profile. And we want to hold the asset that actually has the physical footprint. So when we're talking about rail tracks and roads, we want to own the rail track and the road. We don't want to own the buses or the locomotives. So the investment philosophy that is applied to the fund, it's pretty straightforward, simple stuff. Only invest in core infrastructure, ensure that every asset is really high quality. If you want to provide downside protection, you don't want to be investing in low quality assets. Even if they're very cheap, there's still higher risk in those. And also when it comes to quality, this is where the sustainability really comes in. These are very long-lived assets, so you really want to be at the sustainable end, because a lot of the valuation comes from the outer years of the asset, so after 2035. So that's where the energy transition and the low carbon is really important. And only after that do we look at valuation, and more from the perspective of you don't want to buy a new asset at too high a price, because that will lock in lower returns. And then once you've got a really nice basket of high quality assets, you want to spread the risk and spread it broadly across regions and sectors. So this slide gives you just a snapshot of the portfolio as a whole. We have 40 stocks, nicely evenly spread across developed markets in Europe, North America, UK, Japan and developed Asia. And also a nice spread across sectors as well. Some examples of the stocks we hold in the portfolio: Canadian Pacific, a very large freight rail company across Canada and the US. Pennon Group, fully regulated water utility, and also poles and wires on the electricity side. We really like those as well, particularly from the perspective of growth as the world transitions to renewable energy. So these are fully regulated assets, but they have this really nice tailwind of growth coming through, because every wind and solar installation that gets built, you have to put an extension cord out to. And so for a regulated utility, for every dollar they spend on doing that, they can then earn a return. And that just gives you that extra dividend growth that you're going to see coming through time, that then kind of compounds your returns over the years. The way we think about ESG, and this is the low carbon element as well, is that we only want to invest in assets that can still generate cash as we transition to zero net emissions. So it's a bit of a mouthful, but you can call it a maximum 2-degree warming pathway compliant approach, or just a Paris target compliant approach. And again, we want to do this while still maintaining the defensive nature of listed infrastructure. So you can kind of play infrastructure as a higher risk, kind of push into the clean tech space a little bit if you really want a green infrastructure portfolio. But you just got to be careful about the risk that you're taking on with that in terms of wholesale electricity prices, and it tends to be a little bit more boom and bust on the renewable energy development side of things. So that's kind of where we want to play this more from the regulated end of and the defensive nature end of core infrastructure. So as an output of the way that we approach this, the fund does have a very low carbon footprint, particularly relative to other listed infrastructure indices in the space. So between 50 and 70% lower. And I think that's probably actually higher, given that some of the data, particularly around the facilitated emissions, still a way to go there, but improving. Facilitated emissions are very important. For most sectors, Scope 1 and 2 will be the most important. But if you think about something like a railroad that ships coal, the railroad itself doesn't burn the coal, so it actually has really low headline emissions. You want to actually look through into the underlying nature of the asset and what the real risks are. And so Scope 3 captures that a little bit better. So just to wrap up, in Whitehelm Capital, specialist infrastructure manager, we've been doing it for 23 years. Investing through a number of market cycles now, with deep experience in unlisted and private market infrastructure and infrastructure debt. Listed infrastructure can give you a really nice diversifying allocation for an equity portfolio. We think it should be a defensive part with a nice yield, low global equity beta, and lower volatility. Fees of the fund are quite reasonable, and it's very much focused on high quality assets. And it's a benchmark unaware, very much focused on absolute risk and return rather than trying to beat a benchmark while still participating in the downside. So very much focused on preserving investor capital where we can. And we think sticking to core infrastructure really captures the best benefits of infrastructure as an asset class, while keeping an eye very firmly on long-term sustainability. Thank you.